I think the banks see this as an opportunity to come back into the advice module, into the advice world through AI/hybrid models. And whereas old school advisors are seeing this as a sort of, oh God, how are we going to be able to contain the risk if nobody's specifically defining the difference between necessary information and sufficient information? And yeah, so interesting. Because I remember when we were talking about it, Vivek, you sort of said your view is this paper's out of date.
This is my controversial view. Yeah, we're going straight to hyper-personalized advice like we've never seen it before. I think that's where we're going to. I think it will take time, but I think it's been accelerated by recent technological advancements, which allow for the leveling up of digital experiences beyond where they could be, let's say 2 or 3 years ago. Like, I think the ability now for building out customer journeys that are so much more conversational, so much more engaging, they can go a lot deeper and be a lot more dynamic than what we used to build before, and really like hit all those notes of like really getting to know someone at a deeper level, what makes them tick, the nuances around their goals, and the stuff that otherwise only advisors could pick out. But I think is going to be super exciting to explore, and I think it's going to open up a whole new set of possibilities that we didn't have available to us before. And I think it would be a waste if they stopped at guidance. I feel this kind of new generation of experiences that get built out, they should go the whole hog, and they should be as useful to people as they possibly can be. Super personalized, super specific.
I agree. So if you look at that in the context of, so if we look at what are the key proposals that this paper's doing, first one I would say is this movement from necessary to sufficient information. And I think there's a debate to be had on that. Okay. There's then the ending of the mandatory annual review and the shift towards periodic suitability reviews. I think there's a debate to be had there. There's a little bit around the attitude to risk concept. And to me, this highlights to me that I think that the industry's put attitude to risk and capacity for loss as if they are two things the same. And I almost see them as completely opposite, and the attitude to risk is very much about someone's willingness to take risk. Whereas capacity for loss has got nothing really to do with that. It's more to do with, can you take risk? And then if you can take risk, is it then aligned to the level of risk that you're prepared to take? And I think those two aren't, I think there are many advisors who do it very well. Okay. But I'm not sure that the tooling necessarily and the outcomes necessarily really make that difference very clear, because I see loads of scenarios where somebody has got a very high attitude to risk, but no capacity for risk. Right? And they are two different things. They really are. And vice versa. You see it the other way around. You see a lot of people who don't want to take risk at all, but they could take a lot. So there's a bit around that. Then there's the tackling of the Legacy Trail Commission as well. That I think is another core bit that's come out of this paper. And it's around, sort of, to me, it's around whereabouts is this likely to lead? What's the market change? What are the responses that we can expect from the industry? Because we've got to remember as well, with this is only a consultation paper, right? And sometimes people read into them thinking, oh, the FCA have got this wrong, or the FCA have got that right. And it's sort of like, no, they're putting some of this out because they want to consult and get views.
I mean, the thing that struck me about this whole necessary and sufficient thing was it was one of those times where it kind of brought back memories of the many conversations we've had internally about this. I remember having conversations with you, Mike, directly on this, like, what is necessary? What do we have to collect? What do we need to collect in order to generate a recommendation in this space? Because our approach was always holistic, like, we thought quite deeply about this information collection point, particularly because we had our own app in the market. Like every additional question were percentage points off in terms of our conversion through the funnel and everything else. So we were acutely honed in to this very conversation around like information collection versus what you get out of it in terms of actual value, in terms of the recommendations you can generate. And so like it, to me, it almost was like one of the first times I've seen the regulators get closer to that product level thinking, because not everyone needs holistic advice. And you don't need to go through the very elongated fact finds for everyone. But at the same time, we also did come through this point when we had our own product, which was around, you do also want to ask enough questions to uncover maybe some of the aspects customers are maybe not aware of that they should be considering, that you should be bringing into the conversation. And I think that's something that advisors are very good at doing. And we learned firsthand from observing them and seeing how best to go about doing that. And to me, often like we have this thing in like when we talk about great advice, right? Great advisors ask the right questions, ask great questions, right? They have a knack of like being able to figure out whether there are other aspects of someone's financial life or beyond that they need to kind of dig a little bit deeper into. But to me, this kind of whole necessary to sufficient thing, again, will allow the building out of better digital hybrid experiences that will be more engaging, that will have far better conversion metrics. It'll be a better funnel. And it will also allow for maybe like the atomization of advice. Like you can maybe do, it was kind of like something that we were looking into when we had our app, right? Like we were looking at these branch back finds, maybe providing advice in certain areas. And then over time, we always wanted to get to the point aspirationally of providing recommendations across the full scope of someone's financial life holistically. But we were always acutely aware that to begin with, there were certain entry points that would bring a customer in that they were focused on day one.
What do you think of I'm going to say, dare I say, probably the industry sentiment around this very much moves against firms' desires to have clear boundaries of what they should or shouldn't be doing. And as much as this, well, the good thing with this is it doesn't change how people are operating if they want to carry on doing what they're doing. And the question I've got is the industry going to prefer to stick to the current known scenario, right? We have to do this, and then we know we are broadly covered, and therefore the FCA don't get the change through technology, no doubt, that they're ultimately looking to achieve, which is widening the advice gap, bringing down the advice gap.
It depends what you mean by industry, Peter, because I think actually that point is, I think, the crux of this consultation paper, right? Like it's very clear to me what the FCA are trying to do with this is allow for firms to launch like a wider set of propositions to market than what's out there today to better fit what customers need and desire. And I think it's going to allow for a lot of innovation. It's going to allow for firms to launch propositions that aren't quite so binary. And whether that means it's a classic advice firm launching something that can cater for the clients who are coming through that they'd otherwise turn away, or a bank starting to provide recommendations to someone who's just got a current account and a savings account. Or we're seeing this in the industry today, right? We speak to many different types of firm across the industry, whether they be banks, life cos. We're speaking to a whole bunch of master trusts now. Obviously, the advice firm, wealth management segment as well. And I think they're all going to have a different take on what for them will be the high priority initial propositions that they want to build out on the back of this.
Yep, agree. Totally agree. I think firms will I'm playing a bit devil's advocate here because, sort of I'm part of an AI focused company, so I'm fully on board. However, I can see that firms are going to be worried about what they deem to be sufficient today, 5 years down the line, when investments maybe haven't performed so well and complaints go to the ombudsman, how is the ombudsman are they going to agree that it was sufficient, or are they going to deem it to be insufficient? And this comes back to the point around firms liking specifics about, if I do A, B, C, D, E, then I feel as if I'm doing what I have to do to tick the box. And I think this is part of what the next step of this and the white paper will ultimately need to deliver are the comfort for firms to take things forward, for the banks to sit there and think, yes, we can re-enter the advice market, for example. I think it's an area where AI can help. I really do think that AI can help, but not being the CTO of the firm, I wouldn't necessarily know the expanse or how far it can go, and actually where the guardrails need to be within this type of new framework. I don't know if you have any thoughts on that, Mike.
Yeah, I think that in some senses, Vivek's already said how the technology is making actually more personalized advice more possible. And to some extent, that does mean that I think for people who really want to give personalized, high quality advice, this is not necessarily going to, I think, change their interactions with the customer to some degree. It feels to me like it's a lot more focused around people who don't really want to have that holistic conversation, but do have a smaller product mix that they want to be able to recommend, which obviously technology can also help with. It can help with the smaller set of data collection you have to do for that. It can help with the execution of the product recommendations. But I think that, yeah, I think to some extent, this is flying in the face of what the technology is making increasingly possible, which is the more personalized view. And I think really that probably says a lot about who it's targeting, which is probably larger firms that aren't particularly ready to make those technological steps because they're slower moving, because they have compliance challenges in the past that are difficult to overcome, but still want to be able to offer something like advice to large pools of customers.
Yeah, agreed.
Yeah, I think at the macro level, if you look at Peter, you're going to have to correct me if I'm wrong here, because like my history is not going to be as good as yours, right? But my sense is that I'm not calling you old, but my sense is, like, if you look at the noughties, you know, that kind of decade, there were a whole bunch of like mis-selling scandals. There were probably mis-selling scandals before then, but like I'm just my history starts, let's say, in 2000, right? And you know, linked to structured products, this, that, everything. RDR happens, 2013. The conversations around all of that were a couple of years earlier, and from 2013 to where we are today, there's Consumer Duty. There was like a whole bunch of, there was FAMA that came out after RDR, which then precipitated the setting up of the advice unit. But it almost feels like there's been this journey where there's been this alignment of the provision of financial advice to what the FCA has always wanted it to be aligned to, and I guess ultimately the government, which is like good customer outcomes, right? And to me, a lot of what's coming out in this paper is more of a framework, or the beginnings of a framework, and an acknowledgement of where technology is today in terms of like the part it has to play in that. There are, many different dimensions to that, but it's almost like, look, we knew this when we went through the advice unit back in 2017, 2018. But there was an acknowledgement back then of, look, technology is going to have like a big part to play in kind of helping bridge the advice gap, or it's going to help bring advice to a lot more people. There was the whole robo advice thing that happened that didn't really it maybe helped like a small subset of people within that advice gap. It didn't really have the intended impact at the outset of that. I think where we are today is there's an acknowledgement that where technology has got to will have a meaningful impact. And it's trying to put a framework together, or the beginnings of a framework, to help firms explore that and build out propositions that will be able to help. And it's almost like the end point of that arc, right? And whereas before there was this whole thing around, oh, we're totally agnostic as to the way advice is generated and the way it's provided, as long as there is someone there who is responsible for it. That was what was said, but that wasn't necessarily what you experienced going through the process. I think this is kind of maybe bringing it closer to that way of thinking, where it's really just down to all it really kind of properly boils down to is driving the good customer outcomes and giving a bit more flexibility around all the different aspects covered in this paper, whether it be information collection or attitude to risk or whatever it is, the suitability letters. There's so many different aspects of it, which just point to something that is a lot more proportional rather than absolute.
I find with that point that there's a very clear reliance on consumer duty keeping coming up to fill these gaps. And is that a bad thing? No, I don't think it necessarily is. But again, consumer duty is very outcome based and subjective, and it comes back down to this sort of fear of regulation in hindsight, but which is all part of the purpose of the paper at the end of the day. Was there anything you wanted to add there, Mike?
Yeah, I think the technology has been there, I think, to deliver personalized advice in a lot of cases and to fill that advice gap now for a while, even before the kind of current improvements in AI. But because ultimately there's going to be a person who's responsible for it from a compliance point of view, because ultimately someone has to look at what the technology can do and then interpret, as Peter said, that necessary or sufficient information collection, has to interpret the rules as written by the FCA. The technology is only one half of the puzzle. The other half is confidence. The other half is a sense of where where best practices are. And what I've seen, looking at chatting to people who work in compliance and who are, trying to understand what the technology can do, they look at obviously what you show them, but they also look at what other people are doing. They look at things like this from the FCA in terms of signaling about what's acceptable. They build comfort gradually. They want to paddle before they swim. They need basically to see things having time in the market, not having loads of complaints, not having lots of ombudsman activity around them before they're going to get comfortable. So although I think the technology is moving quickly and has moved quickly, I think the other side of things is the people who have the in positions of responsibility catching up with it. And that's something that I think is accelerating. I also think that, there will be large opportunities for, I think, very large players who are happy to make the first move to potentially hoover up a lot of the market, because we know that a lot of people want this. We know that the advice gap is a real thing. We know that, even for the demographics well served by the current advice industry, that there is frustration around the technological side of that it's not easier, that it's not quicker, that it's not more integrated with the kind of technology that they're used to dealing with. So I do think that there's a market opportunity there for a large player who's happy to get comfortable with the new technology.
Agreed. I think an interesting point that comes out of this paper is the FCA are very keen that the qualification requirement is still there. You're using level 4 qualified advisors. And I know that there'll be some pressure or feedback back on them about how do you expect to get costs down if you are keeping that qualification level there. my personal view on this is comes back to technology. And I remember when we had our direct to consumer app, how many recommendations were effectively going under my name and yours, Vivek, as well. And we were able to do it at the costs that we were charging. And it just says to me that unless you are going to change something, such as your proposition, which I think links into periodic and annual reviews, but unless you're prepared to change your proposition and your methods of working, yes, you are going to struggle to bring your costs down to serve advice. That's my take on the qualification gap. But again, we're seeing models out there where you can, or where the thinking is that you can have a qualified advisor who is overseeing the advice, but they're not necessarily have to be the person or method of delivery. I don't know if you've got any thoughts on that, Vivek.
To me, I think a lot of this depends on the end clients, right? There are clients that we've come across who are very happy to consume advice fully digitally. There are those who absolutely every step of the way, they need to speak to someone because they need that reassurance and confidence, and that's just who they are. And there's every kind of flavor of that in between as well, right?
Yeah.
There are those who are fine with something digitally, but they want to know that they can pick up a call or an appointment with an advisor if required. So there's so many different flavors of that. What we do know, our advisors are critical when it comes to providing that reassurance and confidence to do something, particularly when it's something new, someone's never done before, it's totally out of their comfort zone, which things like investing is very much in that wheelhouse. And I think, to be honest, there is, like, coming back to the point that Mike was making, I think a big thing, that point around that technology has been there for a while around being able to generate recommendations and construct a cash flow and calculate essentially what someone should be doing, that essential kernel of information that is the recommendation itself. The diffusion of that, I think, is now the big thing, right? And that's what needs to happen in order to really get to that high level of societal impact that we always wanted to achieve. And I think a critical bottleneck, and a lot of the firms that we speak to who have quite literally the millions of customers who kind of need this service, who need more help with their money, who need some advice and some recommendations around their investing, their retirement, whatever it may be. For them, the key bottleneck has been this compliance aspect, because there has been that level of ambiguity in the rules. There's been, case law, historic case law. There's been essentially a gray area in terms of how a number of these cases would be dealt with. And I think the FCA should be applauded for trying to provide some clarity around that going forward.
Mike, any thoughts around the technology and the sort of the requirement to still have a level 4 qualified advisors, but yet keep costs down?
I mean, I think, the challenge a little bit is that obviously when you make advisors necessary and you make that a premium role by the requirement of qualifications, you encourage firms to look for solutions that don't involve advisors as much as possible. And there, I think the interesting challenge for me, coming to this a little bit from outside the advice industry originally, is that what consumers think of as financial advice is not necessarily what we are concerned with regulating, or what the FCA is concerned with regulating. Things like budget analysis, even cash flow analysis, savings and assessment of broad allocations. All of that can be done without you falling into the category of advice. And if you're a firm who already has an existing relationship with a customer, you might be a challenger bank or, even just a high street bank, you may have some confidence that if you take the customer through those steps, that ultimately when they actually go and look for the specific products in question, because they already have a good relationship with you, because they already have they're going to take your products regardless of you making a specific recommendation. Now, obviously, to what extent you facilitate that pathway is probably a question compliance officers think a lot about. But it seems to me that you'll see more firms trying that and providing a lot of guidance essentially, and making the bet that their existing relationship with the customer, the use of their UI, the other things that they offer are going to mean that when the customer actually takes out the product, they're going to use them. I'm not sure whether that's a good thing or not. I think provision of that guidance is great for the customer, actually, particularly if they can get it in a more self-service format. That means they don't have to, engage with a long process. But obviously, if we really think that those regulated products that are ultimately going to move their money into require advice or require thoughtful analysis, it opens up scope for the process to be abused.
I mean, in my mind, I think we're getting closer and closer to what our original vision was when we first started that company, right? Like an advisor in your pocket. It's there, it's on demand, it's providing you the level of depth and detail that you want in that moment. Like, it's not always like super detailed suitability letters with reams and reams of risk warnings. If you just want to ask a quick question and get a bit of a direction, you can get that. But if you want to actually take some action and move a significant proportion of your wealth into a set of products, you can get that detailed analysis and cash flow and everything else you need done. And on the back of that, you get that feeling of reassurance and confidence with your money, right? And the ultimate thing we're looking to achieve here is to switch that default setting of people's finances being, disorganized, anxiety inducing, and generally crap. I guess it's the catch-all term to just being great, right? And like fully aligned with what people want to achieve in their lives, when they want to retire, how they want their money to grow, how they want to protect their family with respect to life insurance and all the rest of it. I think we will get to that point of alignment, because we will be able to build experiences that really deeply understand our clients, and we'll be able to build experiences that provide those very detailed recommendations explained in exactly the right way for each client, in very personalized language and metaphors and everything else. And beyond all of that, if someone needs to be connected through to a face-to-face advisor or a call with an advisor, whatever it is, we've got a lot of experience with making those connections as well.
It's quite interesting that the consolidation of COBS 9A and 9B into one single chapter. One of the bits I picked up in this was the statement or the point around attitude to risk, and the fact that you don't always need to have these sort of more complex psychometric testing for maybe simple advice scenarios. When I thought about this, I thought about where we were 20 years ago and how it was done, and where we're potentially leading in certain scenarios here. I'm not going to say the word about turn, because I don't think that's fair. But I think that the end outcome of risk profiling could be simpler, but it did get me thinking about what technology can possibly do. And I'm really thinking about, off the back of audio recordings or Teams meetings and transcriptions, as to how the meeting as a whole can possibly do some of, I'm going to say, simple psychometric testing, but without actually having to ask somebody to go through and answer a whole load of questions, just from the words they were saying. So I don't know if you had any thoughts on how that might progress. There's almost like, I'm not going to say a green light, but there's a green light to saying that, well, there you go, green light. A green light towards making risk profiling simpler. And it makes me think, well, how could we achieve good outcomes, but keep it simpler?
I think technology will have such a huge part to play there, right? I think the current system is almost there to fit the old kind of way of doing this, with form paper-based system of questions that you fill in, multiple choice. You get to a point where you can categorize people. You do it with like science-based questions and responses and categorization and everything. But why shouldn't that be done more often? Why can't there be other data inputs that come into it if you can ingest it?
I like
use that and leverage that
so
accurately. Sorry, go for it.
I was saying, I like the way you said the old way of doing it. My old way of doing it was much more simple.
Right, okay.
How evolved.
Yeah, well,
And from a journey, and I'm picturing myself in front of the customer, talking to the customer, that bit of suddenly going into risk profiling does kind of stop the flow in many ways. You have to then pick up again afterwards. But I was particularly interested, maybe Mike, you might have some on how audio recordings, Teams meetings, for example, if there is scope for some form of indicator of risk off the back of how the meeting itself went and the way the client conducted themselves, or am I too far off into the future with that?
Well, I think the technology is definitely possible for it to do a much richer analysis than we've had before, not just of risk, but of vulnerability and other things that the advisor might not be picking up, but at a subservice level. I think, again, the challenge is always going to be the technology can do it. Whether compliance officers are happy with that being the way you assess it is a different question. I think the reason why, maybe you're more likely, therefore, I think, to see it as flagging or analysis of an other change in risk profile or an assessed vulnerability status that's been done through another pathway, so that you're using that newer technology as a way of, I guess, giving you more confidence that your more battle hardened approach is giving you correct results. So I think that is more likely to see how you might see it be adopted. I definitely think there are more things possible, and even just a more in-depth conversational way of assessing risk, I think, is much more possible. We obviously there are a whole way of doing risk profiling. You have some ones with standard questions. I think the ones that do it best are the ones which really actually present the customer with something like what the real experience you're trying to capture. Your money changes like this. How do you feel about it? How do you feel if it goes up and down like this? And you can obviously do something a lot more personalized, a lot more customized, and a lot richer with generative AI. So yeah, I definitely think there's a lot of potential for the technology there. There's a lot of things that it can already do with what's being done. But I think there's this other side of the people in charge having the confidence to go with it that doesn't necessarily solve.
Another part of the paper talks about, and these two I think could be seen hand in hand, or they could be seen separately, and it is the shift away from annual review to periodic review, but then also potentially the trail commission threat, those old contracts that were paying revenue that, whilst many firms would treat them in the same way as newer advisor charging models, that shift is going to have an impact on certain firms out there. Is there any thoughts you had, Vivek, on, first of all, that shift and possibly the trail commission being dropped, the threat of that?
We're seeing this with our clients at the moment, right? They are building out multiple propositions to serve their various client segments. And one of the differentiators across those propositions is the frequency with which they provide a review, or the minimum, or should I say the minimum frequency, with which they provide a review. I think if you take a step back, like, when does a client actually need a review? Yeah, that's something that we thought quite deeply about when we had our direct consumer version of Aura. There's different factors to that, right? There are factors to do with a client's circumstances changing, new job, it could be starting a family, it could be, whatever it may be. But there are changes that take place, and that necessitates, that could potentially necessitate changes in their financial plan. But there's external things as well. Like we saw this firsthand, right? There are just moments in time, just due to general news flow, where clients are just a lot more nervous about their investments. They need more of that reassurance, or there could be some announcements around changes in pensions or changes in investing, or whatever it may be. With first-time home buyers, we saw with interest rates. There are points in time where it is part of that role of an advisor to go and explain, in terms that clients can understand quite in a way that is relatable what all of these things kind of mean for them, and also behaviorally coach them not to, not to sell when the market's down or whatever it is that in the long run can really damage them and their finances. And in the worst case scenario, just leave them burnt, right? So that, I've come across people who are now well into their 60s and have actually missed out on decades of returns from the market because of an experience they had maybe 30, 40 years ago in the stock market where they did something that was totally, they put all their money into like 2 or 3 names, which ended up going under, got burned, and then vowed never to invest again. And that's just not an outcome you want for society at large, right?
Any thoughts, Mike?
Well, I think slightly related to that and what we were discussing, but my perspective is that risk profiling is doesn't really make sense in the first place. Like capacity for losses is ultimately what's important, and beyond that point, I think I'm not saying that everyone should be very 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 risky or very risk averse. I think beyond that point, if you actually understand what the customer can has at stake, I think there is almost a sensible set of options that will achieve the best outcome for them based on that. Maybe there's a little bit of scope for their personal preferences around essentially their utility curve around certain different outcomes, but I think even that is quite constrained by actually, again, comes back to their kind of capacity loss. Like, what does a certain, how precarious is their current income needs? What does a shift away from what does losing a certain amount actually mean in terms of their lifestyle, in terms of what they can afford? I think those are much more pertinent questions actually, and that where someone's attitude to risk is maybe, as Vivek says, shaped by past bad experiences or other things that perhaps are not the best way of getting them the best outcome in the future. But I think that's well beyond the scope of this particular paper. It's just maybe how I've seen it, having thought about this for the last 10 years or so.
One other bit that I came out in my head as I went through this paper, and it's really just a closing comment that clearly the FCA are trying to speed up advice, first of all, trying to close some of the barriers down for giving advice. It's sort of consolidating MiFID and non-MiFID POBs rules. However, we've still got trust-based pensions that sit outside of this. And it's quite interesting to see if there will be any movement in regulation of trust-based schemes to possibly support this. Maybe one for the future to look out for. Lee, is there anything else that you think we haven't covered or would like to see a bit more on?
If you're a financial services firm reading this, what would be your first thoughts for the company, or what would you be looking for in the future as part of this consultation?
Well, it depends on the type of financial services firm, but some of them should be super excited about this. This is allowing them to do what they've been wanting to do for quite a while. But for certain parts of the firm, I think, again, you got to look at a firm as like a collection of different departments. There'll be a product and proposition and customer focused department that will be so excited about this because they've been wanting to work on this stuff for you. I would go as far as saying years. And I think this will provide some more clarity around what it is they can and can't do.
I think so. I think, and you mentioned there about maybe different departments seeing things in different ways. I think risk and compliance will continue to be looking for we want clarity, which is fine. That's their role, isn't it, to mitigate risk? And I ultimately would like to think that from advisors' perspective, the people who are on the coal face, that they see that this is to support technology coming along to help them do their job better and open up propositional opportunities for them to do things that they maybe haven't even thought of before. And I think that's going to be an outcome of this, even if initial noise focuses around clarity, how do we get costs down, et cetera, et cetera. That's the way I see much of this.
Do you think it's more exciting for incumbents or fintechs?
Incumbents, ultimately, I think you can split into those that have got good, strong relationships with their customers and they see them typically face to face. And that's the way those people like to be serviced. From that perspective, I don't think there needs to be seen as a threat from fintechs, but I equally think that these rule changes open up the opportunity to fintechs to fill this advice gap. Ultimately, we're trying to fill an advice gap here. And unless incumbents can get their costs down or change their propositions to support it, technology is a natural way of filling this gap, especially as a lot of where this advice gap are about people who want to be serviced through technology. They want to access information here. They don't necessarily want to be waiting for an annualized call for an advisor to come round and take up time, because they want the information now. So I don't think there's a reason to be threatened by it. I think there's a reason to be challenging yourself and your propositions, but for fintechs who want to drive through change, this helps. That's my thoughts on it.
Okay, I can agree more, and we're actually seeing that sign, right? We're seeing that sign firsthand from a bunch of firms who are looking to get into the world of like more advanced levels of helping people with their money, and ultimately go all the way through to advice, and who want to build products that cover more and more areas of someone's financial picture. More and more of those different products that help them not just at certain points in life, but from start to finish. I think the firms that will be most excited will be those who are very forward thinking, particularly when it comes to tech, and will also be the firms that already have millions and millions of customers and established products that they know serve their customers well. And like the missing link is advice, other recommendations around the products themselves. Like ultimately, there'll be a whole bunch of firms out there who see advice as their core avenue of distribution, essentially. And this will unlock a lot of potential for those firms in particular.
But still require the guardrails to be in place, which I think we've been saying for years now. About technology requires guardrails, and this supports that really well. I'm going to ask Mike if he has any final comments.
No, I think as ever, I do think that we've talked about how, regardless of whether you want looking at more personalized advice or whether you're looking at, making the most of these changes in regulation to open up new sorts of advice journeys to more customers, from the technology point of view, technology is going to be enabling both, I think, and I think increasingly, one thing that's definitely true, you talked about the FCA looking to technology to address the advice gap. I don't see us bringing more human resource in to address it. So it's always going to be technology enabled, whether that's professional, qualified advisor servicing more clients, or whether it's more pathways that don't necessarily need to involve that advisor at every stage. Either way, I think technology is going to be enabling both of those. And I think firms are going to have to, the perspective I have for a lot of these firms is you're already in the tech business. All of your customers are interacting you now with via tech. Even if you're a traditional advice firm, you're almost certainly taking a large volume of your calls over Teams. You're almost certainly processing execution of products via information technology systems. You are increasingly having to maintain some sort of digital presence, be that a customer portal or onboarding or, digital risk profiling, whatever it might be. So yeah, from my point of view, nothing about this, changes that. And if anything, it opens up more avenues for tech to support closing the advice gap.